You've finally opened your brokerage account. You're ready to build wealth. But here's the problem. Picking the wrong, lazy option could cost you thousands in hidden taxes. Most people think index funds and ETFs are basically the same thing. They aren't. And that tiny misunderstanding is a leak in your portfolio that drains your returns over time. I've spent years analyzing the fine print of the world's biggest funds, from Vanguard to Fidelity, so you don't have to. I've helped thousands of investors stop the analysis paralysis and actually start moving the needle on their net worth. In this video, we're settling the showdown. I'm going to reveal the hidden structural difference between these two, why one can be a tax nightmare while the other is a tax haven, and exactly which one you should buy based on your specific goals. By the end of this, you won't be guessing. You'll have a mathematical reason for every dollar you invest. Let's dive in. So, you've done the hard part. You saved the money. You opened the account. Now you're staring at the search bar. You see index fund. You see ETF. They both track the S&P 500. They both hold the same companies. They look identical. But here's where the panic sets in. If they're the same, why are there two different versions? Is one a trap? Is one eating your profits through hidden tax drags? Most experts will tell you it doesn't matter. They'll say, just pick one and start. But that's a lie. Because in the world of compounding, a tiny difference in fees or a surprise tax bill in December isn't just a small detail. Over 20 years, that small detail is the difference between retiring at 55 or working until you're 65. You're paralyzed because you know that one wrong click today could cost you thousands of dollars in the long run. And the worst part, the big brokers love this confusion. It keeps you staring at the screen instead of putting your money to work. You don't need more options. You need to know which one actually keeps more money in your pocket. So here is the deal. Both index funds and ETFs are essentially baskets. You buy one share, and you instantly own a tiny piece of hundreds of different companies. On the surface, they look identical. Same stocks, same growth. But the asterisk structure of these baskets is where the hidden costs live. If you put the wrong one in the wrong account, you are essentially handing the government a tip they didn't earn. Let's start with the index mutual fund. Think of this as the old school way. You send your money to a provider like Vanguard or Fidelity, and they manage the pool. Here is the trap. Tax efficiency. In a mutual fund, when other investors want to leave, the manager often has to sell stocks to pay them out. If those stocks grew in value, it triggers a capital gain. Now, here is the kicker. You have to pay taxes on those gains, even if you didn't sell a single share of your own investment. ETFs, or exchange-traded funds, solve this with a legal loophole called in-kind redemptions. Instead of selling stocks for cash, they swap them. This means almost zero internal capital gains. This is the $1,000 difference. Over a decade, those small annual tax leaks in a mutual fund can eat thousands of dollars of your compound growth. Now let's talk about access. Index funds often have minimums. You might need $3,000 just to get in the door. ETFs. You can buy a single share for $50 or $100. There is also the trading speed factor. Index funds only trade once a day after the market closes. ETFs trade like stocks. You can buy at 10 o'clock a.m. and sell at 10:05 a.m. if you really wanted to. So, how do you build the lazy portfolio without the mistakes? Rule 1. If you are investing inside a tax-advantaged account, like a 401k or a Roth IRA, the tax difference doesn't matter. In these accounts, index funds are often better because you can set up automatic investing. You tell Fidelity or Vanguard to take $200 every Friday, and it happens in the background. No manual buying required. Rule 2. If you are using a standard, taxable brokerage account, go with ETFs every single time. It is the most tax-efficient way to grow wealth in a taxable environment. One is for automation. The other is for tax protection. Pick the tool that fits the account. Now, knowing the difference is one thing. Actually implementing it is where the money is made. If you're still on the fence, I recommend using Fidelity, Vanguard, or Interactive brokers. These are the gold standards for low-fee index funds and ETFs. By switching from a high-fee mutual fund to a tax-efficient ETF, you aren't just saving a few bucks. Over 30 years, that hidden difference can easily be $10,000 or more in your pocket instead of the brokers. That is the power of the lazy portfolio. Stop letting choice paralysis kill your gains. Check the links in the description to open your account today. And if this helped you clear the fog, hit that subscribe button. Let's build that passive income together.